Okay.
There are lots of things that we can do to effectively move the capital gain into this period, even though the closing is in the future period. And so
Okay.
I'll give you one anecdotal example of that as well. We had a client that owned a valuable piece of property. The deal was slated for in the vicinity of $50 million, but it wasn't taking place until September. This was now a couple of years ago. And there was some uncertainty at the time of whether the capital gains rate would change in that budget. It was one of the past budgets, and we've been expecting a capital gains change for the last number of years. And so what we did for him in order to effectively lock in or give us the ability to lock in the lower capital gains rate is we had him create a corporation and form a partnership with that corporation. And then that partnership, when you roll property into a partnership, you can elect that cost or fair value. And so what happens is when we pass the budget, if they do trigger a big capital gains increase, or capital gains inclusion rate increase, what we can do is elect that fair value retroactively. We can elect that fair value, trigger all of that capital gain back when the partnership was formed, which would have been pre-budget. And then when he closes in September, there's effectively no capital gain, right? We elected at fair value back when we formed the partnership. And so now this partnership owns an asset with a cost equivalent to fair value. And so there's no capital gain in September when the land is eventually sold to the third party.
Because effectively, the gain was triggered back with the partnership time frame, as opposed. Okay.
Yeah, this structuring is very complex and very nuanced. And so I definitely want to emphasize this is something to get help with. This is something to engage professionals with because there are nuances to every little situation. And so what works for one may not work for others. You want to make sure that all of these intricate Income Tax Act rules work effectively for your benefit,
right? And to your point, each strategy has its own inherent risks.
For sure.
That most recent example you just said, if the deal doesn't close, he effectively just claimed that he's going to pay his tax. So there are other aspects of risk.
That's right? Exactly right. Yeah. Okay. If you don't end up closing the deal, you run into a situation where you've triggered a lot of tax and you have no cash. So you definitely want to be careful about when to use this strategy. And typically you want to use the strategy when the deal is relatively certain. This isn't something to trigger. You don't want to trigger capital gains on the family cottage, right? The family cottage is going to stay in the family's name. You don't want to pay all that capital gains tax today when you still want to have the cottage. You would have to come up with cash to pay for that.
Right.